Hi, my name is Selena, and today I'm going to be presenting flex credits. The title of this presentation is Flex Credits, What Are They? So today we're going to be going over the following topics. We're going to talk about flex credit definition, things to know, flex credit amounts, use of flex credits, where excess flex credits go, maximizing flex credits, flex credits versus flexible spending accounts, re-electing spending accounts annually, and then we're going to go over some open enrollment 2026 information. So let's start with the definition of flex credits. Flex credits are a county provided benefit, which we refer to as flex credits. You receive flex credits twice monthly to help pay for your benefit plans. When we are dealing with the entire calendar year, there are 26 pay periods in a given year. Flex credits and deductions are only on 24 of those pay periods. That means the months where we have 3 paychecks, you'll only see your flex credits and deductions on the first 2 checks of that month. Flex credits can be applied towards the cost of your healthcare plans, various supplemental insurances, and flexible spending accounts, known as FSAs. Things to know about flex credits. Flex credits allow you to pay for any eligible benefits. They carry no cash value. They are regulated by the IRS, and the amount that you receive is based on your job classification and medical coverage election. Flex credits are automatically applied to the plans that you've chosen in a very specific order, which we will go over later in this presentation. You only pay the difference if your costs exceed your flex credit amount. So let's go back to the part where it says no cash value. This means that at the county, if you do not use all the flex credits that are being offered to you, then you forfeit anything remaining because the county does not give you the opportunity to cash them out and receive them in your paycheck, nor do you have the opportunity to put them in any type of retirement account. You use the flex credits on the plans that we have available, or you forfeit them. Those are your only options. So let's talk about how to determine how much flex credits you're going to be receiving. So flex credits are determined by 2 criteria. One, your bargaining unit's labor agreement, and who you are enrolling in a county medical plan. Annually, we have benefit summaries posted on our year-round website, and for Open Enrollment 2026, your new benefit summary is available on our Open Enrollment website. You can search for your benefit program to determine the level of flex credits that you will be receiving for 2026. Here is an example of the different dollar amounts that you may receive based off of who you are enrolling in medical. So if an employee is going to enroll themselves only on medical, they will receive the dollar amount located in the column that says employee only. If an employee is going to enroll themselves and one dependent on medical, like a spouse or a child, they'll receive the second column, that dollar amount 701 as an example. Then, if an employee is going to enroll 2 or more dependents onto a medical plan, then this employee would receive $1,020.50 to go towards their premiums. Again, what you are seeing is an example. Your dollar amount may be different dependent on your job classification and the benefit program you have access to. Let's go over some examples of how flex credits are applied. So right here, what you're seeing is an employee who intends to enroll their family onto a medical plan. So this employee is going to receive the family level of flex credits. That is $1,020 with 50 cents. This employee has chosen to enroll in the United Healthcare Performance HMO plan, the Delta Dental PPO plan, the Vision plan, and they have picked up some life insurance. This employee does have an out-of-pocket cost per pay period, $376 with 66 cents. The reason that this employee has an out-of-pocket cost is because the total cost of the plans that they have chosen exceed the amount that the county is offering in flex credits. When that happens, the employee pays the difference between those two numbers. So what we can tell from this example is that the employee is using all of their flex credits on the medical plan. And we can determine this because we can clearly see that that medical plan exceeds the amount of flex credits that are being offered to them. However, instead of it being that really big scary number of $1,303 with 45 cents, it's reduced by that $1,020 with 50 cents, making that premium much more manageable. So once the employee pays the difference between those numbers and they've added dental, vision, some life insurance, that continued to increase their per pay period out of pocket. So again, once you total the cost of the plans and you subtract the flex credits that the county is offering, you get the difference between those two numbers, which is the employees per pay period out of pocket. In this example, that per pay period out of pocket cost is $376 with 66 cents. In this example, the employee is going to enroll themselves only onto a medical plan. So they receive the employee only amount of flex credits. And in this example, that's $462. They have chosen to enroll in the Kaiser HMO plan, Delta HMO, Vision, critical illness, and picked up some life insurance. In this example, once those premiums have been totaled, and the flex credits subtracted from that amount, the employee actually has some left flex credits, which we refer to as excess flex credits. The excess amount is $14 with 97 cents. So remember, I mentioned that flex credits are not cashed out to employees, meaning this employee will not receive $14.97 in their paycheck. That $14.97 is automatically going to be defaulted to the health reimbursement account, also known as the HRA. So in this example, the employee's per pay period out of pocket is $0. And the reason for that is the flex credits being offered to them covered all of the plans that they've chosen, so they do not have an out-of-pocket cost. Their plans are completely covered by the county. Pop quiz. Which benefit premiums are covered by your flex credits? Is it A, medical, B, medical, dental, and vision, C, medical, dental, vision, critical illness, supplemental life and AD&D insurances, voluntary short-term, long-term disability, or D, none of the above? What do you think? Let's see. The answer is C. Remember, you can use your flex credits on the following plans: medical, dental, vision, critical illness, supplemental life insurances, AD&D, voluntary short-term disability, long-term disability. If for some reason you have flex credits left over after they've paid for all of those plans that you see in letter C, then anything left over will get default appropriate spending account. How does one maximize the use of their flex credits? This typically happens for employees who are going to waive the county medical plan. So, for employees to maximize their flex credits, they should try to use all the flex credits being offered. Because the county does not cash out employees for unused flex credits, it is in your best interest to choose as many plans as you can that those flex credits will cover. If you don't and you leave some flex credits available and we have nowhere to put them and they can't go in a spending account, then you forfeit anything remaining. So, if you are covered under a high deductible plan, this happens when you have chosen one of the county's high deductible plans, or you're waiving county coverage, medical coverage, that is, due to being enrolled in someone else's high deductible plan, like a spouse or a parent, or maybe you even have a second employer. When that happens, if you have leftover flex credits, they get defaulted to the health savings account, or you can put them in a dependent care FSA, or you can default them to a combination of the two accounts. If you are covered under an HMO plan or a PPO plan elsewhere, and your total cost is less than your flex credit allowance, anything left over would be put in the health reimbursement account, or you can have it go to dependent care FSA. So that middle example, that orange example, that's specifically for employees who are going to waive the county medical plan because they have an HMO or PPO plan elsewhere, or they have chosen a county HMO plan and they have leftover flex credits. It automatically goes to the health reimbursement account. The third example that you see, if you're going to waive the county medical plan because you are on an individual plan, such as TRICARE, Medicare, Medi-Cal, or Covered California, you will have up to $500 of your flex credits put in the healthcare FSA for the year. You also have the option to fund a dependent care account FSA with those flex credits if you have the need for the account, or you can have both of those options available if you need a dependent care FSA. One thing to note about this slide is that you do see dependent care FSA as an option under each example. A dependent care FSA will only be established for you if you log into open enrollment and you make an annual pledge for that account. That dependent care FSA account is specifically for children under the age of 13 for childcare expenses while both parents work or a parent works. And the types of expenses would be preschool, before or after school care, babysitting slash nanny situations, camps when the kids aren't at school. So we're talking summer camp, winter camps, those types of camps, spring break camps. If you have a dependent who is disabled but over the age of 13, you can still use this account. And if you have an elderly parent or possibly maybe a spouse who's incapable of taking care of themselves and they are your tax dependents, then you could potentially use a dependent care FSA for them as well. However, the most common example for the dependent care FSA is for children under the age of 13 for daycare expenses while you work. So let's talk about the difference between flex credits versus flexible spending accounts. Remember, all employees receive flex credits, but not all employees will have a flexible spending account. Flex credits are used towards eligible health plans and potentially spending accounts. Flexible spending accounts are pre-tax savings accounts to be used for qualified expenses. So though the name sounds similar, they are different. Flex credits are again that dollar amount that the county is giving you to help pay for your benefits. And then spending accounts are going to be established if you have leftover flex credits to fund one, Or you choose to put your own pre-tax dollars in these accounts for eligible expenses to use throughout the year. Again, employees only have a flexible spending account if they have excess flex credits or if they elect to fund one with their own pre-tax dollars. Let's talk about re-electing spending accounts annually. So if for 2025, you had or have a dependent care flexible spending account, you must log into open enrollment and make a new annual pledge for 2026. Whatever pledge you allotted for 2025 does not automatically roll over for 2026. You must log into open enrollment if you have an out-of-pocket contribution going into a healthcare FSA. And if you have a health savings account and you have an out-of-pocket contribution going towards that account, then you must log into open enrollment. Remember, a new annual pledge will have to be selected every open enrollment. The county cannot anticipate what your expenses are for 2026. We do rely on you as an employee to inform us of that information. So if you have any of those spending accounts that you want to continue for 2026, you do need to log into open enrollment and you have to make an annual pledge for the new plan year. Again, the pledge amount from the previous year does not roll over into the following year. Time for another quiz. True or false? The county gives me flex credits that fund a spending account. Once funded, I can use them to buy my health plans. What do you think? Is that true or false? Let's see. False. Remember, every county employee will receive those flex credits from the county to purchase their plans. We're talking medical, dental, vision, critical illness, the life insurance policies, short-term, long-term disability, and if at that point anything is left over from those flex credits, then the county will establish a spending account for you with those remaining amounts. The reason why the county does that is because the county does not cash out employees for unused flex credits. So rather than taking it back from the employee, we place it in that spending account for you to use throughout the new plan year. Let's go over a sample pay stub. Why are flex credits on my pay stub? Well, the county needs a method to distribute flex credits to you. The flex credits then offset the cost of the deductions shown. Flex credits are not considered taxable income. So anytime you're looking at your paycheck, you are going to notice under hours and earnings, the first line item is flex credits. It's a good idea to verify that flex credits are on your paychecks and they are the correct amount based off of your medical election or your medical waiver. At the bottom, you do see your deductions. And this is where it gets a little bit confusing. You don't just see what you are responsible for paying, you see the full premiums in relation to each plan. Just remember that you're not paying those full premiums. Those premiums are being offset by those flex credits that you see under hours and earnings. Let's take a look at this graphic. This is a nice way to get an idea of how flex credits are applied. So remember at the beginning of this presentation, I mentioned that flex credits are applied automatically and they are applied in a very specific order. So let's go to the start. Flex credits first go towards medical. Then if there's any remaining, they go to dental, then vision, then critical illness. Let's stop there and look at checkpoint number 1. If you still have remaining flex credits to use after it's paid for the first 4 plans, then they go on to pay for supplemental life insurance and spousal life, supplemental AD&D, voluntary short-term disability, and then voluntary long-term disability. Once we get to checkpoint number 2, if you still have leftover flex credits to use, then you have the option to put them in a dependent care account, or they get defaulted to one of the other spending accounts. We're talking the HSA, the healthcare FSA, or the HRA, whichever is applicable. Open Enrollment 2026. Our Open Enrollment website is now available for you to review our 2026 plan options and enhancements. So on our website, take a look at the What's New flyer for 2026. That's going to give you a nice summary of the new plan options and highlights for the different plans that we have available for 2026. Learn about 2026 plan offerings by joining our carrier seminar sessions. On our open enrollment website, we do have our seminar schedule available for you to view. That way you could take a look at any seminar that you'd like to attend. Our seminars are recorded, so if you can't make a particular seminar, a recording will be available on our open enrollment website. Join us for PeopleSoft navigation session. So October, I will be hosting one PeopleSoft navigation session. That date is available on our open enrollment website, but I don't mind telling you that date is going to be October 7th. That will be recorded as well. So if you're watching this video after that date, you can still find our recording of the PeopleSoft navigation session. That specifically is going to go over the different screens associated with your enrollment in PeopleSoft. So we'll go over some of the common errors that you may come across, and then how to make changes and elect plans and enroll different dependents onto your plans. If you need to speak with someone on our staff, you have the option to schedule a one-on-one session with a benefits division HR analyst. We'll be sending out different flyers or different emails throughout September and October, and you will have the opportunity to book us through one of those different flyers. In addition to being able to access us through those one-on-one consultations, you can always email us, and I'll show you the email at the end of this presentation, and you can always call us. Email is usually the quickest way to get a response, but no problem if you prefer to call us on the phone. So let's talk about open enrollment from start to finish. Be informed. During the month of September, familiarize yourself with updates, enhancements, personal needs for the 2026 plan year. If you're watching this video in the month of October, please remember that we have a lot of recorded seminars on our open enrollment website, so you can also familiarize yourself that way. Log into PeopleSoft as many times as you like from October 6th through October 30th. Once you have made your final choices for 2026, please print/save your benefit summary. You will not receive a confirmation email from the benefits division. I repeat, you will not receive a confirmation email from the benefits division, and we cannot verify for accuracy if you call or email us during open enrollment. If you're going to be enrolling any dependents, like a spouse or children or stepchildren or an eligible dependent for the first time, please remember to submit your marriage certificate or birth certificates or potentially other court documents for those dependents. Again, you only need to provide those documents if you're enrolling those dependents for the very first time for 2026. During the month of December, PeopleSoft will reflect your 2026 choices. If you see something different than what is on your printed/saved benefit summary, please contact our division immediately. You see the email address right there? That is an excellent way to get a hold of the benefits division. while. Actually, fairly common. People check their open enrollment elections the day after open enrollment closes, and they get a little bit worried because they don't see their new elections. Again, you won't be able to see those new elections until about December because the Benefits Division spends most of November, actually all of November, finalizing all of those choices that employees have made. So again, you won't be able to verify your open enrollment elections until December of 2025. On January 1st, 2026, your open enrollment choices go into effect. So again, even though the county opens open enrollment during October of 2025, your changes aren't applied until January 1st, 2026. Our year-round website is available for you again throughout the year. We do have an open enrollment website available to you throughout September and October for you to view 2026 plan information. Summary of benefits are also available year-round, and your 2026 summary of benefits is available on our open enrollment website, so you could take a look at your new flex credit amounts and any premium changes for the different carriers. That concludes the flex credit presentation for today. Thank you very much for taking the time to review what flex credits are, and hopefully this video clarified any confusion that you may have or have had about flex credits. Again, if you need to reach us, I'm going to go back one slide, and you can email us at that dhrbenefits.fgg@sdcounty.ca.gov. If you'd like to call us, no problem. We could be reached at 888-550-2203. But again, email is probably going to be the quickest way to get a response from someone at the Benefits Division during open enrollment. I hope you have a nice day, and again, thank you for joining me.